Warren Buffett, Charlie Munger, Peter Lynch, Jack Bogle, and Benjamin Graham all have one thing in common. They know how to make a lot of money and had previously done so or continue to do so in the market. So today I'm going to talk about how to master stock market investing, how to become an expert at investing. And no, I am absolutely far from it. My investments are down over 50% in the last 2 and a bit years that I've been investing. So absolutely whatever I say is not financial advice, but I'd like to dive into what the pros use and what theoretically would make for a perfect strategy without diving into the actual proper too in-depth details of a DCF, discounted cash flow model, because I think that goes a bit beyond. So this bit will remain quite broad. And to start, we could be looking at Benjamin Graham. Now, this is an investor that you should know of, as he is effectively the grandfather of investing and was a professor that actually had Warren Buffett as his student, although I'm not sure about that in terms of actual college, more or less an investment student. Regardless, Benjamin Graham believed heavily in a margin of safety. He would invest in good quality companies. Those good quality companies would be qualified as having minimal debt, having a good return on assets, as well as having lots of cash flow. These businesses would therefore mean that once you valued the company effectively by looking at the underlying fundamentals, it would effectively mean that you could get a good margin of safety on your investment. So how would this work in practice? Well, you could look at a company in, let's say, the UK, let's say Games Workshop, and you can do a fundamental analysis and say, you know what, Games Workshop, based on my valuations, they've got little to no debt. In fact, they have none. They've got plenty of cash flow and high profit margins, and they've got a good return on assets. When I value their business, let's say they're valued at something like £40 a share. If Games Workshop was currently trading at in or around that, or even below that number, then it would become a very effective value investment, and therefore you would have a margin of safety. If something happened to this business, as if it went, for instance, bankrupt or it had to go into administration, the shareholders would receive a piece of that, providing obviously that they don't have any debtors, and that piece of that investment there would, well, hopefully, if you've done the fundamental analysis correctly, be greater than the current share price, and therefore you would by default be making money. And that effectively, in a very, very basic vision, is how his investment strategy worked. Now, Warren Buffett picked up upon this, and he obviously learned from Benjamin Graham throughout his life. Now, Warren Buffett has done exceedingly well over the last 52 years, I think averaging an annual performance of about 20.9% over that 52-year horizon. And Warren Buffett took it a little bit further. He looks for companies with strong moats. So whilst Benjamin Graham was certainly diving through the rubbish and finding just those businesses that were critically undervalued, Warren Buffett took it a step further to look for companies that had a moat. And by having a moat, this means if you imagine a castle on a hill and you imagine that moat around it, it meant that it was very difficult for foreign invaders to get through to the castle and, let's say, kill the king. Now, in this position, it means companies have certain competitive advantages that make it very difficult for smaller companies or other competitors to enter that space. This therefore means that they're able to defend their market share and territory and work very well. I suppose a good example of a company with a moat would be something like Coca-Cola. Coca-Cola has a very wide range of brands, which effectively means that they have a lot of dominance in terms of market share. Not only this, they've also benefited from being much larger at scale, and I'll talk about economies of scale later on in the video. Because he's found these businesses that have strong moats, it prevents them from getting in easier, and therefore means that the company is likely to continue making profits. Now, this isn't to say that there isn't going to be disruptive or innovative companies that come into the space, but these companies will likely combine what Benjamin Graham also had mentioned with limited debt, high cash flow, and it basically means that they'll be able to invest or reinvest back into the business and be able to effectively adapt and be very agile in doing so. These companies with strong moats would be expected to be around in the next 40 or 50 years. So companies such as Unilever, for example, is a company that holds like Marmite and many, many other products. We may still see them in 40 or 50 years as well. Charlie Munger is Warren Buffett's right-hand man. And this gentleman here is very, very fine with words, to say the least. But Charlie Munger had a moment with Warren Buffett and said, because Warren Buffett's original investment strategy was very akin to that of Benjamin Graham, where they were looking for perhaps poor quality companies at fantastic prices. Now, these poor quality companies were poor, but you could get them at such a fantastic price that it would obviously eventually pay off, providing the shareholders realize that value. Now, Charlie Munger came along and said, well, it's actually better to buy a fantastic company at a fair price than it is to buy a fair company at a fantastic price. And expanding upon this aspect, obviously, has very much helped Warren Buffett in his long-standing career, is a great way of saying, okay, look, don't buy the rubbish companies, buy the quality companies at a good price, take into account that margin of safety that Benjamin Graham was talking about, and therefore use that in your investment strategy to therefore decipher and go, okay, look, we've got good quality companies that we're holding for the longer term, that we've got at good prices. These companies are going to have strong moats and they're likely going to stick around. Therefore, it's unlikely that you're probably going to lose too much capital on this if you've done your valuations correctly. And therefore, over the longer term, you're likely going to beat the markets, at least in my opinion. Now, Peter Lynch, almost on a tangent here, goes off in a very similar but different aspect. And Peter Lynch, very simply put, invests in companies that a 5-year-old could understand. Now, this isn't to say that Warren Buffett or Charlie Munger don't do this as well, as they certainly do try to keep it simple in a lot of aspects. For instance, Warren Buffett pretty much exclusively avoiding technology, despite Apple taking up a majority of Berkshire Hathaway's holdings at the moment. Regardless, keeping it simple is a great way of understanding your investment. Let's say you're buying a retailer and you've gone into the store, you've had the opportunity to try the products. I think this is an effective way of being or having a qualitative analysis. With this analysis, you're able to go, okay, you know what? I've gone into a Nike store. I really like the quality of the products. I've seen a lot of customers in here and I see a lot of brand loyalty. However, there's this new competitor called, let's say, Reebok, for instance, and they've got a store. You go in there, well, you've tried on the trainers and they're quite low quality. The prices are attractive, but you don't really like the designs. And therefore, you also see that Reebok isn't popular in person. And it allows you to go, okay, right, you've seen this in person. You've observed it. You've done your qualitative analysis. Okay, so how does the supply chain differ? Well, it's likely going to a very simple business model in terms of a retailer. And it means you can avoid a lot of these more complex biopharmaceutical companies or biotechnology technology companies that you don't really understand what's going on along that process, where they've got many years before a patent can even get put through, and then it's got to go through all of the stages of the clinical trials, and you've also got to know specifically more about that specific drug and what it can tailor to and how much it costs to produce. Again, it gets very complicated, and I like to follow this rule myself. Invest in simple companies that you can understand very clearly and be able to explain it to a 5-year-old if needed. You never know when that opportunity might arise that you might try and get a bag holder or a 5-year-old to hold all of your Boohoo shares for you or buy in at your loss. Regardless, Nick Sleep and Qais Zakaria, I've said his first name wrong here, they had a fund together called Nomad Investments. And in this fund, they had I believe a 10 or 11 year period. And in this period, the S&P 500 the MSCI All World Index managed to gain about 110%. Now, the Nomad fund managed to get about 900% or just above that. Now, what was unique to their strategy, or perhaps unique, but it was very focused on behavioral aspects. And this is something that I completely agree with. Understanding the behavior or the psychology of other investors. Now, Charlie Munger is also very adept at this, very good at this as well, meaning that he's able to identify the weaknesses. And he, in fact, avoids being stupid or avoids stupidity. And he attributes that as one of the most successful parts of his strategy, at least that I've read. Now, I've got a good book recommendation for you as I continue on, but Richer, Wiser, Happier, written by William Green, is a fantastic read. And it really breaks down a lot of the different strategies here and talks about different investors in different scopes, such as John Templeton, also talks about Warren Buffett and Charlie Munger, as well as Nick Sleep and Qais Zakaria. Now, if you want a link for this book, there's one in the description down below, and you can buy it on Amazon there. One of my favorite reads of all time. But as I was talking about, there is a lot of behavioral psychology in investing, and you really need to understand your own emotions. Understanding or realizing what a common mistake might be, where you get too emotional, where you either react with fear, anger, or you react with excitement and greed. Now, when you combine these, or at least the two sides of the coin, it means it puts you in an irrational way of thinking, and therefore you may be prone to panic. You might see a stock fly up and go, well, I need to buy now, because if I don't buy now, I'm going to miss out on all the gains. And because of that, you forced yourself, or you've broken your own strategy. So behavior is certainly key. I do also like the Nick Sleep's strategy. They really focus on economies of scale. Now, economies of scale is effectively saying, and if it is an economy of scale and not a diseconomy of scale, as the business gets larger and grows in size, they become more competitive overall. For example, Costco is a fantastic example of this. Costco, as they've gotten larger in size, are able to substitute the price of their products and reduce the price of their products in their stores. This is because they make sufficient capital and money through their annual memberships. Because their annual memberships are effectively providing the profits for the company, they can discount their products to extremely competitive levels, so that therefore it's very, very difficult to compete with. Now, Amazon have also done this in a very effective manner. Now they've got AWS, or Amazon Web Services, it effectively means that they can be heavily profitable and grow very fast with their cloud Amazon Web Services, but they can also literally run their retail segment of the business at a loss. And because they're doing this, they're undercutting the competition, and by undercutting the competition, they're going to see more demand, and they're able to therefore do very well from it. That excess in demand means they're likely going to gain market share over the longer term. And we've even seen this in terms of another economy of scale, in which they've become, as they become larger as a company, they've built more warehouses, and this means they've led to faster delivery times, and it's a cycle, and it keeps going round and around and round. And economies of scale is very important in investing, because it believes, well, in my opinion, you can therefore look for companies that you can see growing over the longer term, and therefore decipher, okay, you know what, these companies are growing over the longer term, I think they're going to become more efficient as they do it, and therefore it's like a revolving cycle that as it goes up and up and up, it continues to compound with your investment. Jack Bogle, or Jack Bogle, however you may say it, is the creator or founder of Vanguard, and his strategy actually is attributed to low-cost, broad-based index funds. Now, I know I'm throwing it off on a tangent here because this video isn't exclusively about individual stock picks, but it's certainly a relevant notice. Now, if you can't beat the market, you can obviously replicate it. So if you're investing in low-cost, meaning low-fee index funds that track the global stock market, then at least if the global stock market is doing something, you're going to be earning returns on your investments. Now, this is great for the kind of investor that doesn't have too much time or energy to put into learning or understanding their investments, and therefore would just rather invest in, as I say, the global stock market. Now, if the global stock market's down by an extreme amount, whereas if you compare this to a stock picker that's lost a stock that's down by an extreme amount, if the global stock market is down by that high amount, it's very likely you've got bigger problems ongoing, whereas the stock picker might have just picked a bad stock and had a bad allocation strategy in terms of diversification. Maybe like myself here, where I only hold 2 stocks and I'm down 50% overall. But there is a beauty to this index fund investing, and this is because it's so broad, it's a very easy process, and it's low fee. With these low fees, you're effectively able to grow your capital at a consistent, average rate anyway. Some years it'll be up, some years it'll be down. And if we look at something like the S&P 500, over the last 30 years, on average, it's gained about 8% per year, which is no small figure. Now, if the global stock market is able to do similar amounts to that as well, that's a respectable amount. And over the longer term, we can say, you know what, it's very likely it's going to replicate this in the next 30 years. But it's all about the long haul, and that's the way I feel. Thank you for watching. Have a fantastic day. If you have anything more to add, leave it in the comment section down below.